Welcome back to the podcast and welcome back to the YouTube channel. The YouTube channel is Kraig with a K, Kraigstrom. Yes, that's right. If you're listening on the podcast, there is a YouTube channel. And when I say that I am recording from the basement in Smithfield, Maine, you can go to the YouTube channel, Kraig with a K Strom, subscribe, hit the bell icon and notifications so you know when I'm posting a video from the basement, or the next video actually is going to be from our land here in the Smithfield, Mercer, Maine area. We've got a piece of property. I'm going to do a podcast about buying raw land, buying real estate, and I'm going to do it from the property. That's at least my current plan. But you have to watch the YouTube channel, Kraig with a K Strom. You'll find me there. And you have to watch the YouTube channel in order to actually see the video. Who knows? We might see turkeys. We might see deer. We might see, I know there was a skunk there this morning. Thankfully, he wasn't there when I was there, but he passed through sometime last night. So this podcast episode, though, is going to be on a different topic that was actually from a listener who asked a question about buying a business. And more specifically about buying a business using seller financing. Now, this was a question that originally came from my friend and client, actually, who's a listener, watching Codie Sanchez, C-O-D-I-E Sanchez. Codie Sanchez is just an amazing personality, but she's also obviously an outstanding entrepreneur, truly has built herself a phenomenal business model with both business, entrepreneurial enterprises, but tying it together with the marketing machine of YouTube, social media, TikTok, etc. And this question came from one of my clients, a friend who listens to my podcast, actually watches the podcast on YouTube and saw it there and said, "Hey, what do you think about this Codie Sanchez and what she says about buying businesses using seller financing?" And I actually love it. It's something that I'm somewhat familiar with. I'm 25 years in practice in the financial services world. I'm a certified financial planner. I'm also a paralegal at a law firm where we do seller finance buyouts and partnership buyouts at the law firm and so forth. So it's kind of cool to get that question from a client because this person, she's actually interested in buying a particular business. So she'd started Googling it and doing some research about, hey, how do I analyze this particular deal or that particular deal? And she found Codie Sanchez because Codie Sanchez has done an amazing job of marketing her company, educational company where they teach largely seller financing, but how to buy a business. And one of her big hooks on her videos is how to buy a business with as little or no money out of your pocket as possible, right? And so that's where my client came to me and said, "What do you think of this?" And I said, "I'll tell you right now, generally upfront, seller financing is an amazing way to go, especially with the number of businesses, but let me analyze the deal." Because they had already signed a non-disclosure agreement with a business they were interested in buying, and they had the actual revenue and expense documents, the actual valuation numbers to plug in. And I said, let me geek out on that stuff. I would love to see it. So that's actually what I'm going to go through today, is just to give you, if you're interested in buying a business or seller financing, on how it really works. This will be a good overview. It is not by any means going to be the level of education that Codie Sanchez gives in her classes, but just some feedback from a certified financial planner and a paralegal on a business and estate planning law firm side, and just the perspective from that angle, so that you get an idea. If you want to learn more about it, perhaps you want to send me an email. We can talk more about it. That would be great. Kraig with a K, Kraig, Kraig with a K at Can't even get my own email address right. Kraig with a K at kraigstrom.com. So let's get into this. What I thought I would do is just share some preliminary numbers with you first, basically right off the profit and loss statement from this company. And that's what we're going to say. It's just a company. We're not going to talk about the industry. I don't know what business this is. I don't know where it is. The non-disclosure agreement is being honored, basically. So I'm just going to say this is the prospect business. And the prospect business starts off with, now what you generally want to do, before I say that, is you want to see not 3 years, not 2 years of profit and loss statements. You should be looking at least 5 years of profit and loss. 5 years, folks, not 1 year, 2 years. 5 would be good. And having access to the accounting documents, the taxes to back it up. Like actual filed taxes, not just made up 1040s and various things and 1099s. You want to see real tax documents. And that's why you should be totally happy signing a non-disclosure agreement. Okay? Because somebody's not going to be excited about sending you their taxes if you haven't signed a non-disclosure agreement. So you sign a non-disclosure agreement, you're not going to talk about this thing. Whether you buy the business or not, you shall not speak of business buying club, right? That's the idea. So this is a 5-year picture of the P&L as prepared with the assistance of this business owner's CPA. Okay, so what we see is in years 2018, the revenue for this business was $1.4 million. Pretty solid, in a business. But in 2019, revenue went up to $2 million, a little over $2 million. And then it went up a little bit more to $2,051,000. And then it started coming down a little bit and then up again. And the last year revenue was still holding at around $2 million, almost $2,100,000. Pretty solid stuff. Now, what we're trying to find out, because this is going to be an owner-operated business, what we're really trying to get to is what is the owner's, or in this case, the new buyer, right? We want to know what is the current owner's seller discretionary earnings, SDE, the seller's discretionary earnings. That means what do they get to live on from this business operation, right? Are they eating, as Dave Ramsey says, beans and rice every day, or are they living a life? Do they have a nice car, a good home, or can they pay for the kids' school? Are they doing okay? Do they have a good discretionary earnings from their business? Okay, so that seller discretionary earnings is really the number that the new buyer has to benchmark whether they should buy this business or not against. That's the idea, okay? So in the last year's P&L, profit and loss statement, they had an earnings, let's say, of $2.1 million. Now, we're trying to get to seller discretionary earnings, so we have to basically start right off the bat with this particular business has some very set, fixed, let's say, inventory costs that just come right off the top. So we start at $2,085,000, but those fixed costs that do go up somewhat every year, not tremendously, but those fixed costs are $1.8 million. Whoa. So we took a $2 million number and we lop off $1.8 million to get that top line number, and the gross seller discretionary earnings is $255,000. $255,000. Now, that still sounds pretty good. So if we're evaluating this deal from the perspective of a new owner, we're looking at that saying, $254,000 sounds pretty decent. It's 255 rounded up. That's pretty good. But we have not subtracted the operating expenses from that number. And so we start going through things like advertising, vehicle expenses. Now, vehicle expenses might be an item that you add back into seller discretionary earnings, because that's a case where maybe the owner is running their vehicles through the company and the company's paying for those things. So that is essentially a discretionary item that the business is paying for, their vehicles. Okay, so that makes sense. That could be, all right. But then you've got depreciation on various things, insurance, interest expenses on perhaps loans or financed equipment. What if you have copy machines, expensive items and equipment in a factory or manufacturing? You might have to pay for equipment, okay? Now, the big ones really start coming in and really hit me hard when I looked at the professional fees. Professional fees. What the heck is a professional fee? Well, in this case, professional fee was almost $19,000. Whoa, what is that? Now, let's keep going. We've got everything from repairs to supplies to taxes, travel, blah, 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 all that stuff, blah, 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 blah. Profit and loss, right? So then the next big ticket item, remember, we're trying to get down to sellers' discretionary earnings. What does the seller, the current owner, what do they live on from this $2 million top line revenue company? Okay, $2 million top line. Remember, we've already lopped off this $1.8 million, okay, with just that fixed operating expense, basically, that they have to pay out on a fixed basis, okay? Then we get to the big ticket. The big ticket was, in this case, salaries and wages. Salaries and wages, that is the boogeyman when it comes to these small businesses, and you've got to really dig in and ask questions on this. Now, by the way, salaries and wages do not, in many cases, include the owner. That is not part of the owner. The owner is just taking whatever's left at the end, not necessarily collecting a paycheck per se. So the salaries and wages in this case were $61,000. But remember, I mentioned earlier that we need to check on what the heck is that professional services fee, right? We need to check on what's that professional services fee. Well, as it turns out, that was a separate line item, okay, for someone that handles IT. Basically, this particular company is very heavy on IT and the cost of operations. There's a full-time, almost full-time person, let's call him a part/full-time person, that costs $18,000 a year to have that person connected to the business. Technically, that's payroll, but in this case, it's not payroll that all of us also costs the Social Security taxes and all that other kind of stuff. It's a contractor that covers that, but still, that's essentially payroll. And when you add the $61,000 for employee wages on top of that, you're at $78,000, $79,000 just in payroll. Remember, we started with about $255,000 on that gross top line. When you added it all up, on this particular P&L, you have a net income to the new owner, in this case, the seller discretionary earnings that we're dealing with, the current owner, that seller discretionary earnings is under $108,000. That's quite a drop off $2 million to start with. Now, I'm still not down on this at all. Like, okay, now we know. We know that our number, let's call it 107. We know that our number is $107,000 a year discretionary earnings. Remember, what we're talking about here is how would we buy this business using seller financing? Using seller financing in this case, how would we buy this business? Just a quick Kraig side note on seller financing. The idea behind seller financing is we use the business itself and the profits from the future profits of the business to actually buy out the seller. The current owner is paid out through future revenues of their business. And seller financing, to me personally, is the only way to go in situations like this, because if you really believe in the value of your business, why wouldn't you believe that your business could continue for, let's say, 5 or 6 years to pay you out, so that the new owner can use the running, operating business and pull revenue from that and live perhaps on beans and rice for 5 or 6 years while the business pays out the seller, the previous owner? That's seller financing. Now, you can go out and get traditional financing. You can go to the Small Business Administration and put in an application and go through perhaps months and months of ridiculous underwriting and questions and all this other stuff, but you're still not getting down to identifying a seller that believes enough in their business that they would let the business buy it out. They would let the operations of the business help with the buyout. That means that the seller believes in their business. Personally, if a seller would only take cash or a bank loan finance deal, I don't feel like they've got a lot of confidence in their business. That's just me personally. That's in some ways where Codie Sanchez's message really resonates with me, that seller financing is really it is the current owner demonstrating a belief in their business that the business is strong enough to do this thing, to buy this business out with you, right? So what we do is we take that discretionary number that we found in that P&L, and what we do is we plug that in. What we need to do is just go through a business valuation exercise, and we plug that in to the earnings. Okay, so we're going to say, and I'm going to say this, I'm going to say, what if we had an up year, right? We're going to anticipate a little bit of an up year from the seller's previous year because we're on track. We can see the numbers. We're going to say that we're going to use $110,000, not 104, not 105, which is what we had, let's say, last year in the previous example. We're going to use 110. And we're going to put that in and say, okay, this is our seller's discretionary earnings. What multiple are we going to use? Now, this is important. Businesses are often purchased. In many cases, small businesses are purchased on a multiple of seller's discretionary earnings, because these are owner-operated businesses for the most part. So someone coming in is going to be operating this business and wants to know, hey, how much am I going to live on? How much am I going to have to live on if I'm running this business? That's seller discretionary earnings. And the business is usually valued based on a percentage or a multiple of those earnings. And in this case, this particular industry, and you can find this with a simple Google search, you can Google search business valuation and type in the name of the entity. Alpaca farm, business valuation. This isn't an alpaca farm, but you can find it for the most part in multiple sources. So what I did is I used 3 different sources for a multiple suggestion, and I took the one kind of an average in the middle that was 2.95. 2.95 times the seller discretionary earnings. So that's how it works, 2.95. That's our multiple. So if we take $110,000, it's $110,604 in my example, and I plug that in with a 2.95 valuation multiple, we get our business valuation, the sale price that is driven by the seller's discretionary earnings. We get $326,000 business valuation. Now, this is where the negotiation comes in, right? You first have to have an agreement with the seller that they agree to that valuation. In many cases, the seller, because it's their baby, right? It's their baby. They love their baby. It's just their business. they want a higher valuation number. And the question is, okay, can you show me somewhere that that is validated? Validate why it should be a 4 times multiple or 3.5 or something more, because I've got 3 different sources that have lower, higher. I took the average in the middle. Show me where that is. And then you might find that the seller comes back and says, oh, wow, I didn't even know that was out there. Okay, fine. We agree on that. We agree on the valuation. And now you run through the rest of the steps. So what you do with your calculator, and by the way, if you would like a copy of my calculator, what I did is I actually built this off of a variety of other sources that I couldn't use them to be able to analyze it in one spreadsheet easily. So I actually just made my own. I'm a bit of a nerd that way. So if you want a copy of this, send me an email, Kraig with a K at kraigstrom.com. And in the subject, say business valuation calculator. Start the email with Kraig, you're awesome, something like that. Okay, now, so what I do is I say, okay, you know what? What's fair? A 25% deposit, a down payment, right? Because if you're selling a business and you're going to use seller financing, very much like what I said earlier, where if the seller doesn't believe enough in their own business to use seller financing, I'm a little bit cautious, right? I would say be cautious. But likewise, if the buyer is not willing to put skin in the game, is not willing to put a down payment in the game, well, then I'm not excited about that either, right? I would want you got to have a nice, even, you have to have a compromise in there as far as valuations. And then how you're going to pay for it. So in this case, we put down as an initial calculation a 25% deposit, which means the seller on a $326,000 business, the seller receives a deposit, a down payment of $81,570, 81 grand cash. Now, seller financing. Now we got to figure out, what are we going to finance? Well, that means we're going to finance $244,000. What's the interest rate? Okay. Now, the interest rate is the question to start with. And today in the market, here's the thing. When you look at the interest rate, it's not necessarily a market rate. You want to be fair to the seller, but you also need to be fair to the buyer, right? That you're in a situation right now. Let's say, for example, I'm recording this in 2023. Interest rates have jumped up pretty high. Is now the time to be pegging your seller financing interest rate to a high interest rate and saying, no way, I'm not taking anything but up here? When in reality, over the last 5 years, interest rates have been really low. So maybe there's a negotiation somewhere below today's current high rates and somewhere above 3-4 years ago, very low rates. So what we did is we said, what if we agreed to a 4% interest rate on this loan? And what that does is generates a payment back, okay, a payment every month for, let's say, 5 or 6 years to the seller. The seller gets $3,829 a month. It's a nice bit of cash flow. Plus, they got $81,000 up front, and their business is generating the revenue to pay off that note. And if the buyer defaults on that agreement, the seller can swoop in and take the business back. That's how it works, okay? But what you've got to get to as the buyer, now this is my client. She said, you know, I seems like this could be kind of tight. And so as we did the math, and if we had a 4% interest rate, and let's see, I think it was a 6%, 6-year, a 6-year note. So to pay this off in 6 years and a 25% down payment, she's sitting on $9,200 in net, like seller discretionary income, but she's got to pay out $3,800 to the loan. That leaves her a whopping $5,300 a month in her, now the buyer's discretionary income, right? That's kind of tight. Now, we do have to look at that as just a return perspective. Like, well, if you're getting $5,300 a month, how much cash did you really put up front? In this case, we put up $81,570. And you're receiving $5,300 a month. That's a 79% cash on cash return. The idea with cash on cash is based on putting up $81,000, you're now receiving a net $5,300 a month. That's a pretty darn good cash on cash return, but can you live on that? Can you actually have a lifestyle with discretionary earnings, or are you eating beans and rice, right? So in this case, we started off at this really nice, high, big gross numbers, and then started just really chipping away at it. And then when you run the business valuation, you run the numbers, everything comes down to, that would be really tough in order to actually make it work, right? To actually make it work, you as the new owner would have to come in and likely cut payroll, eliminate that professional services or cut it in half or more, find a way to take care of the professional services, and that's $18,000 a year that's gone. Perhaps cut payroll. Maybe there's a $10,000 in payroll that could be cut. Maybe you just have to work weekends for a period of time. And now what we've got is the net number, right? Instead of a net number of, let's say, $5,300 a month, which might be difficult, now you've got a net number of maybe $6,000 or $7,000, maybe $8,000 a month, and it's much more manageable. And you just got to get through the next 5 or 6 years, and you pay down that seller's note, and now you get the full seller discretionary income that becomes yours as the buyer's new discretionary income goes up because you've cut costs. You might also have plans to make the business more efficient and to grow your customer base and so forth, okay? You might use virtual assistants who are remote in the US or overseas to handle bookkeeping and various things like that. You'll cut costs. There's a variety of different things you might do, but looking at it just from the numbers, wow, we go from what looks like a great deal down to, I don't know if we can live on that. And we haven't even talked about what if the seller comes back and says, I want a higher down payment. Well, how much of a down payment? What if that seller, he comes back and says, I want a 70% down payment? Well, 70% down payment, you apparently, now this is just me talking, they apparently don't really believe in their business to pay them out. So why do they want such a huge down payment, right? Why do they want to have such a huge deposit? That would send up some red flags. But this is part of the negotiations where you can use that business valuation tool to be able to compare numbers and go back and forth. In this case, and now I'm actually saying hi, right, directly to the camera. Those of you not watching on the podcast, I'm waving at the camera on YouTube. I'm saying hi to my client, that she's out there watching this sometime in the near future, that I wouldn't be super excited about this particular deal, but I definitely love the idea of seller financing. And I think Codie Sanchez is absolutely she's someone exciting and just young and energetic about this topic. And I think it's great. Fires me up as well. I love this question. If you'd like to evaluate your own deal, if you've got questions about a deal, also don't forget, if you do a partnership, for example, make sure that you've got a legally binding partnership contract with your partner in the business. Don't just run into it, together and be writing checks and not have anything actually documented. Big mistake, okay? Reach out. Send me an email, Kraig with a K at kraigstrom.com, and I'll talk to you again real soon. Again, don't forget, I think the next episode will likely be on the Strom property here in Maine, and a little conversation about buying land just raw land in the woodsin. Talk to you soon. Bye for now.
Information presented is for educational purposes only and is not intended for solicitation, sale or purchase of any security or financial product. Be sure to first consult with a qualified financial advisor and your tax professional before implementing any strategy discussed here. The term personal pension refers to a marketing name designed to educate future retirees and retirees about the economic principles behind creating their own pension-like income. The term personal pension is not intended to be confused with a defined benefit pension plan offered by an employer or by a government entity.